Welcome to the Global Investor Podcast, a show that focuses on helping foreign investors enter the lucrative U.S. real estate market. Host Charles Carillo combines decades of real estate investing experience with a professional background in international banking to interview experts in all areas of U.S. real estate investing. Now, here's your host, Charles Carillo.
Do you have money sitting in the stock market and you're worried about it? Or worse, you have money sitting at the bank, not keeping up with inflation? My name is Charles Carillo, founder and managing partner of Harborside Partners. And since 2006, I've been investing my money and my family's money into income-producing properties. These are real assets, real properties with real addresses that produce real cash flow. At Harborside Partners, we provide passive investors who love real estate with a turnkey investing solution. If you want to put your money to work in real estate but can't find deals, don't have the time to get funding, and the last thing that productive people want to do is manage real estate. We find the deals, we fund the deals, and we manage the tenants, the termites, and the properties. Partner with us at investwithharborside.com. That's investwithharborside.com. Go to investwithharborside.com. If you love real estate, you like the idea of passive income, and believe that income-producing properties will appreciate over time, go to investwithharborside.com. That's investwithharborside.com.
Welcome to another episode of the Global Investors Podcast. I'm your host, Charles Carillo. Today we have Brian Burke. Since 1989, Brian has acquired over $800 million worth of real estate, including over 4,000 multifamily units and more than 700 single-family homes with the assistance of proprietary software that he wrote himself. He has subdivided land, built homes, constructed self-storage, but really prefers to reposition existing multifamily properties. So thank you so much for being on the show, Brian.
Thanks for having me on, Charles.
So you have a very experienced real estate career. If you give us a little background on yourself, both personally and professionally, prior to getting the real estate bug.
Gosh, there really wasn't much prior. I started in this business when I was 20 years old.
Oh, wow.
And, then I didn't know any better. It was the only thing I could think to do where, maybe I could be my own boss. So I was, when I first started, I was actually working as a checkout clerk in a grocery store. And that was probably for the first few months while I was trying to invest in real estate. And of course, I had no money, so that was a pretty slow process. But then I got into law enforcement and I worked for a local police and fire department for about 14 years while I was building my business. And finally, the business grew up enough where I could supplement or actually substitute my income from the quote unquote real job and hung it up. And that was 20 something years ago and never looked back.
Awesome. So what was your first real estate investment? What was your first real estate investment that you got involved with?
I bought a small rental house for, I don't know, it was like $100,000 or some small number here in California. And this was, of course, 1989. So, you could get a little bit more for your money back then than you could now. And I did it with no money down because I read in a book that,
Carlton Sheets, is that it?
It wasn't it was worse than that. It was a worse book that nobody's ever even read or seen, I'm sure. And, it says that you could you get the seller to carry back your down payment. And I'm like, that's great because I don't have a down payment. So, I just made an offer on this property and I asked if the seller would carry back the down payment. And they're like, yeah, we could do that. And I'm like, oh, this is easy. I guess this is pretty easy to do. So I thought that was going to be my next career, was buying no money down real estate. Little did I know.
Yeah, that's interesting. It's funny because my dad started investing in multifamily in 1984, and I would ask him about it, and he'd be like, oh, yeah, back then we just, somebody signed their property to you. There's no due on sale clause. They signed the property here. I get money back at closing. And it's like, it's a little different today, right?
Just a little bit. Yeah. We did a lot of things back then that, would be much more difficult to accomplish today.
So your firm focuses on purchasing value-add multifamily properties, in addition to other properties and things that you offer. You have one I found very interesting was the opportunistic platform. Can you explain what types of assets you target and how you identify them? Because this is something unique that we don't get too many operators on to do.
Yeah, our opportunistic platform really was born from the early days of Praxis Capital. And I started out in the house flipping business, and I was buying, fixing up and reselling houses, buying them at the foreclosure auction on the courthouse steps. We actually still have one subsidiary where we do still buy properties at the courthouse steps and fix them up and resell them. And I've got a team that runs that operation. And so that's kind of was the foundation for our opportunistic platform, but it encompasses basically anything that we think is a viable real estate opportunity that isn't just stabilized multifamily. So it could be something like we have a partnership where we're building homes on fire lots. We had a fire that whipped through town about four years ago that leveled 5,300 homes were destroyed in the fire, and that left a lot of lots behind. So we're partnered with a local builder. We're building spec homes on those lots where homes had previously been. So that's in our opportunistic platform, and we've just done a few other real estate projects that are arbitrage plays. It's not a big component of our business. It's certainly just a small offshoot, but it does allow us to provide a menu of different investment opportunities to our investors to, some people really like, take on a little bit more risk for potentially higher return. And the opportunistic platform gives us a venue to do that, at least on a small scale.
When I was doing research for this show, I read that only 35% of people that have had fire damage in their homes rebuild it. That's kind of crazy. I think it'd be a lot higher.
I think that's actually probably a pretty accurate statistic from what we saw after this fire here. About a third of the people rebuilt and moved back in. About a third of the people just sold their lots. And then there was a third that are still in limbo trying to figure out what they're going to do. So it's been interesting to watch how that's played out.
Yeah, I imagine it's even more of a fiasco now because of supply chain issues and then labor issues and the whole 9 yards. So it's you might have a lot more people opting for the check versus becoming developers.
Yeah, well, especially now if you're just getting started, because it's going to take you eight or 9 months just to get appliances. Before you could have rebuilt your house in 6 months. Now you can't even get materials for 6 or 8 months. So yeah, it's if you're looking to get back in quickly, it does present some challenges.
Yeah. So you've invested in a lot of different real estate classes. Why do you prefer on repositioning existing multifamily properties over others?
I just found it's what we're best at and what we can scale the most. And it's difficult to scale arbitrage plays. If you're out there saying like, okay, we're gonna go buy rundown properties at a discount, fix them up and hold them or sell them or whatever. Finding old rundown properties at a discount is challenging. There's just not a lot of it. And when you do find it, they're generally smaller. Maybe you're buying a strip mall for a couple $1 million or, some old shop building for 500 grand. And, it's not really all that scalable, and it's usually pretty hyper local. So, you're buying stuff in your own backyard. I just, my backyard is California. I don't find California to be a very good place to invest in real estate. So if we want to go outside of our so-called backyard, that means traveling across the country. And I'm not going to travel across the country to go find some $500,000 shop building I can repurpose into a retail center. Instead, I'd rather buy a $150 million multifamily apartment complex that we can slowly renovate over time, stabilize, and then ultimately resell. So for us, it's about scalability mostly.
So being vertically integrated with that, how does that assist you in scaling? I imagine if you're in so many different, you guys are in a lot of different markets throughout really the whole Sun Belt, like you were just saying. How does that work where you're going to put on your own management on the ground? And so now you're not only just finding the asset, you're putting together the whole management team and possibly a new market or a market that you're growing in.
Well, for us, the vertical integration is just about having total control. Mm-hmm. So, we have full control over the operations of the property. We have full control over the renovations of the property and the order in which we're going to do it, with employees that, basically are they're employed by us. So they do what we say. We lay out the priorities and they do it, versus third party company where you lay out your priorities and they're like, yeah, well, we've got guys deployed at another property. We got to finish first. And then, there's always some excuse. So we have full control over that. Plus we have full control over the financials. We've got enterprise grade software platforms where everything is integrated together. In one system, we can see all of our properties, leasing, rentals, occupancy, income, expenses, everything is all there. And that's an unprecedented level of control compared to fractured third-party management where you might have different management companies in each market, and everybody's kind of reporting to you differently, and you're trying to sort out, different reporting formats and accounting methods and so forth. Instead, we can build all this in-house.
So you can keep, I would imagine, part of it, the operation in your centralized head office location, and then the other ones are on the ground. Obviously handyman, all that other stuff that goes on, services.
That's right. So each property, we invest in properties that are greater than 100 units in size, and in most cases we're over 200 units, but I would say in almost every case we're over 150. And these properties are large enough to support their own staffs. So there's an office at each property, a leasing office, a clubhouse. That property is going to have a manager, an assistant manager, maybe a leasing agent, a lead maintenance technician, a couple other maintenance technicians, maybe a renovation specialist. We're going to have a whole staff at each of these properties, which is overseen by regional vice presidents who are overseen, directly through our corporate office. So
right.
You kind of have to create a whole organizational structure around it, but it's something you can't do with smaller real estate. You just can't afford to have a whole staff for one building, but for larger properties you can.
Yeah, that's the one big plus with going to larger assets versus smaller ones, is just the ability to it's just easier to manage. I mean, that's what it is, hands down. That's what I've found over years of doing it.
Indeed.
But, so talk to us about this proprietary software that you've written and then they utilize. Why did you do it, and what does it really help you do?
Well, our first platform was born out of necessity. When I started buying foreclosures at the courthouse steps, it was a very old, archaic system back then. You would learn about the foreclosure sale through a legal notice in the newspaper that you would clip out, and so it was fun because I would go to the auction, and when I was first getting into this business, I was watching other auction bidders and noticing that everybody was tracking things through, they had a backpack full of manila folders with papers flying everywhere. And, and people were losing track of what was going to auction, and, because they get postponed, and then, I lost that file. So I realized, I thought, there's got to be a better way. So I developed my own software platform that would track all these foreclosure sales and allow us to do title searches and prioritize liens and kind of run basically our whole foreclosure auction business through this software platform. I wrote the thing myself, nights and weekends, and working 24 hours a day for years. It took me years to really get it fine-tuned and dialed in. And that really helped facilitate our growth when foreclosures went crazy. And then, seeing the value of having your own platform that you wrote and did the specs on, when I got into multifamily, I kind of realized we needed the same thing. It was hard to find really good financial analysis software to determine, income and expenses and projections and calculate potential returns and waterfalls and all that sort of stuff for income real estate. So I decided to dip back into the old skill set and do it again. And this time write a platform based in Excel that would allow us to underwrite and analyze multifamily real estate and make projections for return and sensitivity analysis and all that sort of stuff. So that's kind of one of our pieces of our secret sauce that helps us with a competitive advantage.
Interesting. So if you're working with a lot of passive investors to finance a lot of these deals that you're buying, what do you think, I imagine you've been on both sides of it and been a passive investor in other, maybe real estate or other investments. What do you think is most important, or what should passive investors look for when investing in the syndication between, let's say, the operator and then also the property?
Well, I think most important, and this is a debate that always comes up, is people will ask, what's more important, the sponsor or the deal? There's always this little chicken and the egg thing. I've always been a proponent of recognizing that the sponsor is more important than the deal, because a great real estate sponsor can create an incredible outcome out of extreme adversity, but a bad one can screw up a perfectly good real estate deal. So, it's really important for passive investors to understand who they're investing with. And, I wrote a book, The Hands-Off Investor, came out in 2020. That's 350 pages dedicated to everything you got to look for when you're investing in passive real estate syndications. I mean, if you wanted to boil the whole thing down to a couple sound bites, it would be look for a sponsor that has a good track record, a solid track record, and preferably one that survives some market cycles. You want to see somebody that's been able to get through adversity, survive, and be there to live another day. Because if they failed, or if they haven't been around long enough, then they might not have the skill set to get through the next adverse cycle when that comes.
Speaking of adverse cycles, what do you think what's the best way for an operator to prepare for a pullback? And because you've been through probably 2 or 3 of them now.
At least, yeah. I think the best way to prepare is to structure your acquisitions properly. And by that, the most important way that you can structure your assets is to not take on too much debt. When I look back at the collapse of 07, 8, 9, the great financial collapse, as you call it, or the great real estate reset, or whatever you want to call it, the properties that we were buying through foreclosure from banks and elsewhere were dominantly, and I would say somewhere in the high 90s%, dominated by people who took out too much debt. They had zero equity to start with. They were doing 100% financing, or just really high levels of financing. And I'm starting to see that happen again right now. Even in the multifamily side, we're seeing, it seems like most buyers these days are using bridge debt. They're using fairly high leverage. They're doing, 80 or 90% of cost, which could equate to somewhere close to 100% purchase price. With draws coming for future fundings for renovations. And to me, that level of financing is dangerous. Right now, we're financing somewhere in the 60 to 70% of purchase price range, and we're funding our renovations out of cash. So that puts us, post renovation somewhere around 50% LTV, which if we have a pullback, I feel that we have some margins of safety. Too much debt eliminates those margins of safety. You can find yourself winding up in a world of hurt very, very quickly.
Oh, interesting. So what are, other than over leveraging, what are some other mistakes that you've seen real estate investors make?
Well, some of the big ones are they tend to overestimate and underestimate. And that's always in the way that doesn't help them. So they might overestimate how much rent increases they're going to get, or what rent they're going to get. And then they might underestimate how much it's going to cost to repair the property, or they might overestimate their exit price or underestimate their exit cap rate. So there's all kinds of misses, and those are where the misses usually are. It's usually in how much you're going to be able to sell it for, how much you're going to be able to rent it for, and how much it's going to cost you to get from the condition the property's into the condition you want to get it into. Those are the big misses, and they can be a death sentence to a business plan.
Brian, what do you think are the main factors that have contributed to your success over the past few decades?
Well, obviously some tenacity, because getting through the downturn of the real estate crash was not an easy thing. So if I had plenty of opportunities to throw my hands in the air and give up, never did. So I think that was probably a major contributor to our success. I think another contributor was that, knock on wood, after 20 something years of investing using investors' money, we've never lost a nickel of investor principal. And a track record like that helps to fuel future growth, because people recognize that if you've been able to pull that off, maybe their principal is a bit more protected than with someone that doesn't have the same track record. So I think, success breeds success.
Yeah. So how can our listeners learn more about you and your business, Brian?
Best ways are to check out our website for Praxis Capital. It's praxcap.com, praxcap.com. You can also follow me on Instagram at Investor Brian Burke, or check out the Hands Off Investor, available on Amazon, bookstores, or biggerpockets.com/syndication book.
Okay. I will put those links into the show notes, and I want to thank you for coming on, and looking forward to connecting with you in the near future.
I appreciate you having me on, Charles. Thanks much.
Thank you.
Hi guys, it's Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in getting involved with real estate but you don't know where to begin, set up a free 30-minute strategy call with me at schedulecharles.com. That's schedulecharles.com. Thank you.
Thank you for listening to the Global Investor Podcast. If you like the show, be sure to subscribe on iTunes or Google Play to get new weekly episodes. For more resources and to receive our newsletter, please visit globalinvestorpodcast.com. And don't forget to join us next week for another episode.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars LLC exclusively.